The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan of themorganreport.com, December 1st. Well, I want to bring this to everyone's attention. We did a Cyber Monday, which we're extending due to some technical issues. We're selling the Morgan Report for half price. And on top of that, you get a free 1.5 hour consultation with yours truly that you can take advantage of. So I'll get that out of the way, and I'll move on to something that I want to do for this weekly perspective, and that is what's called the Lassonde curve. This was done by Pierre Lassonde of Franco-Nevada fame, and it shows basically what happens on a speculative investment. And these are your penny stocks, your junior miners, your exploration companies, your startups, that type of thing. Many of them are out seeking a certain mineral or minerals, searching for gold, searching for lithium, searching for cobalt, searching for whatever. So this is generally what takes place, and you can see over here, and it's outlined as a speculative investment, and that's exactly what they are. They're high risk. And what happens is you see that they'll start at this area here, and then you'll see them go up, 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 and reach this. Now, this oftentimes can be either on a pump and dump, where let's say the promoters are very adept at getting the word out and flood the market with news and basically pump and pump and pump. These are less and less likely all the time. They do happen occasionally, but any speculation, just when it opens up, and let's say it's the mineral de jour, lithium happens to be hot, for example, it's much more likely to see that in a lithium company than, let's say, a silver company, because silver's just kind of been going nowhere or going sideways or been locked within a trading range or whatever. Anyway, that's what happens, basis a discovery. So please note that word, discovery. It goes up like that because of a discovery. Now, if it goes up like that just because it's being pumped up, you got to be very careful. And even on a discovery, you've got to be very careful, because even on a discovery, it can do this. It can be the discovery was exaggerated, or it's uneconomic, or the metallurgy's tough, or there's not enough infrastructure, or it just got really, really frothy, and the real value, even though it is a discovery, is much less than that peak. So basically what I and many others have taught for years is what we call a free trade. And that is, if you start here or here or here, and it doubles from wherever you got in, then you want to sell your half of your position and ride the rest for free. It's called a free trade. I was first introduced to that by Jim Dines, and I was probably in my 20s when I learned that technique. It serves you well. I mean, you'd be better if the company really takes off and it's a 10 or 20 bagger to own all of it instead of half of it. But it mitigates your risk so much that it's well worth doing it in every case that you can. I think Rick Rule talks about the same thing. So now you have a discovery, and it's been repriced. So started here, and it ended up here, which whatever that delta is between those two X's I just drew, and this is hard to do freehand, but between that level, which is over here, and this level here on this line. So let's just say that's a double. Could be a quadruple, I don't know. Depends on the company, of course. So you've watched it go all the way up, you've held it, it came down, but it's higher than where you bought it. Now, then this is the project fail. Sorry, I didn't, oops, I shouldn't draw it through it, I should underline it. And so it drops back down. This is a successful project in yellow, but then it takes us years of time. And we did it with mines management. In fact, this is a perfect example I'll outline. Morgan Report premium members that have been with me a long time will know this one. So we had mines management, I believe, at around the dollar level, and it went up to 10. So it was a 10 bagger. And then I put a stop in at 8. So everybody that got in at the beginning should have made like 8 times on their money. And it was a real project. It didn't fail. It didn't do this. It did this, but we left it alone. We sold and left it alone. So I came back in thinking I was smart enough to get us in here because it was going to become a mine. It's subsequently been bought by Hecla. So people that came in the second time thinking I was smart enough to get us in here, I was more like getting us in here. And as I just said, it was bought out by Hecla. So you did get some gain. But it's very hard because this could take years. In mine's management case, it was probably 5 years and it still hadn't got to this point where it starts to perform with the market. So the idea is it stays overvalued. We'll just call this its fair value, all things being equal. And I can't draw it perfectly straight, but get the idea. So even way back here, it's still overvalued relative to its fair value after it's actually in production. So that is pretty accurate. Is it this way in exactly every single case? Of course not. But you see the discovery phase, the exploration phase, the feasibility and financing phase, the construction and startup phase, and then the production phase. So these are all at the top up here. You got this propensity to overshoot, and you get eventually into reality and you get a market performer. One thing I'll say about this discovery phase, and not many teach it, is that if there is a discovery and the stock starts to move up here, but we know it's truly valued at this, it's safer to buy it here than it was down here, because now you have a change in the market itself, a material change. You've not become an explorer anymore. You are now more than likely going to become a mine. And so if the market hasn't valued you properly, you can get in at a higher level and be much safer. And then, of course, what you want to do, knowing that it's most likely going to become overvalued, is to sell into the strength. Don't get too greedy. Take the middle, as I've talked about in the futures market several times. Leave some for the next guy or gal, the next hedge fund, the next sovereign wealth fund, the next family office, whatever, and get out. And if you really like the project, you can hold some, or you can, wait in this area, which is extremely hard to do. I know I've tried it a few times. Regardless, there was, I won't mention his name, but a very smart guy, been a broker for a long time. And when Keith Barron made his discovery in Ecuador, the stock shot up like a rocket from, I'll just say from here to here. And he loaded up there and got out there as an example. Basically was done, retired, goodbye, sayonara, see you later. I'm out of the business. And that can happen. That's rare. You have to really know what you're doing, and it's a big risk to bet a lot on a company like that. But Keith Barron's discovery there in Ecuador was quite the discovery, no doubt. So I think I'll leave it there. It's an educational piece. I think I'll be doing more of these. You don't want to put a lot of money into these speculative stocks. You just don't. I teach bet what you could afford to lose, bet a little, win a lot. Don't add to the position unless there is a material change. If there's a material change and you are a premium member, I will give you guidance on going ahead and, let's say, adding the position at a higher level and what kind of risk-reward profile we're looking at. So I think I'll leave it there. I will bow out for this week, and I'll be back with you next week. This is David Morgan of themorganreport.com signing out.
What if I told you that you could go broke in less than 24 hours? That's how long it took for the Dow Jones Industrial Average to plunge by nearly 22%, losing investors billions overnight. The same happened to the FTX crypto exchange and Terra Luna stablecoin. Both crashed overnight, losing crypto investors billions. You need a strategy that will protect whatever amount of savings you have now. We are going to witness the greatest transfer of wealth that has ever occurred in recorded history, and you must understand the following. You can absolutely go broke in one day. We've been helping subscribers weather this economic mess for years. Now it's time for you to get the same insights. What really happens during a major collapse is that the wealth changes hands. You will actually benefit by looking ahead and knowing exactly how to build and preserve your wealth. Putting just 10% or 20% of your wealth into our approach could make all the difference in your financial security and peace of mind over the next few years. Discover the Morgan Report today. Visit our site at themorganreport.com.